Guys, so here's a quick off-the-cuff video just showing you how simple it is to trade indices. So normally I trade the forex market, and for August I was trading on the breakout strategy. Normally the pound against the US dollar or the euro against the US dollar. And as the name suggests, it's a breakout strategy, but it didn't work particularly well for me for August, so that didn't do too well. But there are other options. So this is so simple to trade. This is the DAX, or Germany 40 as it's called in my broker. It's basically the top 40 companies in Germany in an indice. So it's an index basically, and it's top 40 companies. And here I've got the chart. It's a chart of the DAX, and this is an hourly chart. So each of these candlesticks represents an hour of trading. Now you don't need to make trading complicated. And this is slightly different from the London breakout strategy in the sense that you're not waiting for a breakout. This is trend trading. So you're going with the trend, going with the price movement. And it's almost a naked chart. I've just got two simple indicators on here. And these two lines are the moving averages. Now, moving averages are very popular with trading. They're very helpful in swing trading and trend trading. And simply what they are is they plot the, as its name suggests, the average price over a particular period of time, or a particular number of candlesticks period of time. And you can get them in, for example, many different combinations, and traders will mix and match them. But essentially, the longer term moving averages are your 200. So your 200 on a daily chart, for example, 200, 100, 50, 20, and then your short term, you've got your fives. And what traders will do is they will plot them when the long term when the shorter term moving average goes over the longer term moving average, that would be a buy. When it goes the other way, it's a sell. It's as simple as that. But as I say, you can have many permutations. And on here, I've got the two moving averages, okay, and I've got a 5 and 100. Now, there are two types of moving averages your broker will probably allow you to use, and that is a simple moving average and the exponential moving average. Now, on here, I've got the exponential moving average, because the exponential moving average tends to react to price a lot quicker. You'll tend to get into the trade quicker, but maybe get out of it a bit later. Whereas a simple moving average says it's very simple moving average. So, I mean, they're pretty similar. You could use either. For this example, I'm going to be using the exponential moving average. So the black line is the 5. And as I say, you can mess around with these. You know, you can just be the same in all brokers and just click them and alter the length of time for each one. So I've got the 5, which is the shorter one, over 100, which is a fairly long-term moving average. And say this is an hourly chart. I prefer to use moving averages on longer term time frames. I don't think they works well, for example, on 10 minutes or 5-minute charts. I prefer to use it from an hourly chart upwards. Okay. So I just want to show you the start of August, because I say August was really bad for me with the London breakout strategy, but for the DAX it was really good. So, for example, we went in here at 18,407. Now, some traders will wait for the price to cross the moving average. Other traders wait for the moving average to cross. So I'm waiting for the moving average to cross. So, for example, say we went in here 18,409. Now you go all the way down. Now my stop would be set up just above here, probably 18,583. It's something like 180 pips, for example, or points if you want to call it points in indices. So you have to have quite a fairly wide stop, and obviously the margin to cover it. But as you see, it does carry on down once it breaks the moving average. And it goes all the way down. And what you can do is you can have a trailing stop. So the trailing stop will move as the price goes in your favor. So you have a 5-step trailing stop, then every time it moves 5, the stop will move with you. So you're going to lock in profits anyway. So you don't need to be risking that all the time. But as you can see, it goes straight on down. And then we get through to Friday. Now, what will happen is you'll be holding this overnight. So you will get a slight interest or admin charge, but it'll be worth it because the profits will far outweigh it. But then you're holding it over to the weekends or into Monday now. Now, obviously, there is this, well, not a myth, but obviously it can happen. A lot of things can happen over the weekend. So the market could open with a big move in the opposite direction. But bear in mind, your trailing stock should have been moving down anyway. So, you know, I think it's a risk you can take. If your trailing stocks move down, your stop's not going to be as big. But anyway, yeah, some traders are worried about holding it over the weekend. On this particular strategy, I I wouldn't worry too much as long as you know what you're risking. Your stop's moved up in line with the price. So here we are on Monday, and it's still going down. Having said that, come lunchtime, you see this wick here, it's met support. So then it starts going back up again, starts going back up, comes back down again. Now, there are many ways you can exit this strategy. Traditional way would be wait for the moving average to cross. So you wait for the moving average to cross there, and it's 17.6. Okay, 17.604. And initially, that was, so what did we go in at? We went in at 18,400, and it's gone down to 17.6. So that's 800 pips, okay? But there is another way you can exit as well. So that's 800 pips in about a week. Now, what I would do is on IG, I would put just a very low trade of £2 a pip. You've got to have the margin to cover it, but that'd be £1,600 in a week. But if I wanted to gain more profits, there are many ways I could do it. For example, I could look at here. You see here we've got the wick there. It's met some support, and it starts going back up. So once it goes up to there, having said that, it's met resistance there, so it might come back down again. But you could come out about here. You'd be saving a few hundred pips. Or, well, look, if we go on to Tuesday, now bear in mind this is an hourly chart. You can see on Tuesday, 8 o'clock, right through the day, it's not done anything. So you might say, well, at the end of the day, I'll close it out. Okay, there's a chance it could come back down again, but I'll close it out there and I'll save a good few hundred pips. Another way to do it is to do what traders known as a 3 moving average chart. So if I put the 50 in, which splits the difference between that and 100, then I'm going to be saving a few hundred here. So when it crosses the 50, which is the middle one here, which is at 17,494, instead of 600, you're going to save about 100 pips. So there's that way to do it as well. Obviously, the chart's a bit more complicated now, but so you either look at the support and resistance, or 800 pips is still good if you just want it systematically and you don't want the stress of having to work out what's going on. But what I'll do is I'll take out the 50 for now, and we'll carry on. So then, obviously, when you've got it like this, you've got the 2 moving averages, you go the opposite direction, obviously, when it crosses. So now we're on a week down, 8th of August. Obviously, with the hourly chart here and with these 2 moving averages, you're not get as many trades, but when the profits are going to be generally bigger. So here we go in at 17,604. That's on Thursday. We hold it over the weekend again. So 17,604. Then we move across. Got a big swing up. Remember, your stop would move up as well if you're doing the trailing stops. You're locking in profits. And then we're going right round to a week again. Over the week. Now, in fact, coming into, see, it's still staying well above it, and you stop moving up with this, so you'd be locking in profits anyway. It came down a bit there. You see, it hit the wick, got a bit of support. Did go up again, but then it came down again. And now we're into Tuesday, 3rd of September. So it's probably about 3 weeks. 18,796, 17,605. So 18,605. You're looking about nearly. We're nearly 1,000, 18,696. You're looking at, what are we on? So 17,605, okay, and we've come out 18,800. So it's 18,605, nearly 1,200 pips. Okay, it's 1,200 pips in 3 weeks. You do that with 2, that's £2 a pip, that's 2,400. Obviously, if you increase that, 1,200, then you're looking at something. For example, if you do £5 a pip, which is a lot to a lot of traders. £5 a pip, 1,000, that's 5,000. 5,000, that's £6,000, and that's just in 3 weeks. But obviously, you've got the margin to cover it. So if you just I would just do a simple £2 a pip, and that's 1,400. Sorry, not. Let me get this straight. It's 1,200. The difference, £2 a pip. That's 2,400. or if you did just do the £1 a pip, it's 1,200. So it's not bad for 3 weeks, and you don't have to worry about these trades. And if you get the calculations right, unlike me at the moment, but either way, you can see, there's big profits to make. Obviously, it doesn't always work, but if you stick to the system, I mean, it's fairly easy for beginners to understand, because you see you've only got 2 indicators, and you're simply, look, all you're doing is following the price. Obviously, you've got to have the stop to cover it, but you have the trailing stop. Then it will cover it, and as you see, we go down again, and then you simply get out when it crosses again. But if you don't want to wait that, look, you see here we got some support here, got up, but then it did come back in, but then you've got more support, and as it comes back up for the second time, you might say, well, okay, well, I'll get out here. You get out at 18,241 and 18,241, that's 18,449. It's about a couple of hundred pips you've saved yourself. So there are various ways you can do this, but essentially you've just got 2 indicators on the chart, maybe 3 if you put a third moving average in. But it's quite a simple system to understand. Obviously, you don't have as many trades because it's not day trading, it's swing trading, it's trend trading. But it's another tool to have in your armory, and it can be used alongside, obviously, the strategies you use for forex trading, and it's something a bit different. You can maybe try it on the FTSE 100 as well, and the Dow as well. Obviously, the Dow's a bigger indice, and obviously, depending what country you live in, it has different, when you trade, you have different peaks and times when you get in, when you get out. But normally, when you're doing this type of trading anyway, it's normally held for over a day anyway. So, it's not really going to make any difference, obviously what time you get in, as long as you obviously get in when the moving averages tell you to. And as I say, the moving averages, you can adjust these to your own liking. So, for example, you could put a 200 moving average on here, and then it'd be different again. And then you'd have far fewer trades, because obviously the 200, you're waiting for this to cross the 200. So then you have bigger stops, far fewer trades than if you do it over the 100. But say you can try it on the FTSE, try it on the Dow as well. With the Dow, you'd have to have really large stops. Let's say it's quite a big index, but it's easy to understand, and it's quite an easy one to implement. And trading, sometimes the simplest strategies are the best. So don't overcomplicate things. So I just thought I'd show that to you, how easy it is to trade. You don't need to make it complicated. And it's certainly a good one to use alongside, any other strategies you use. And even if you're forex trading, you can use this alongside it as well. So I just thought I'd show that to you today. Pop along to Running Trader, and you'll see more videos of me trading. And I'll see you soon. Have a good day.